Hello friends, welcome to my desk. Today, in this video, we will talk about the basics of debt mutual funds. But first, let me recite a quote by David Allen. It is not the beauty of the building, but the construction of its foundation that will stand the test of time. So, whatever we do in our life, just like a foundation decides the future of a building, the test of time for the building, our understanding of the subject, the basics of the subject will decide the quality of our decisions. So, in this video, we will talk about the foundational aspects of mutual funds and we will answer 3 questions. 1. What are debt mutual funds? 2. What are the risks in debt mutual funds? And 3. What are the different types of debt mutual funds? So, without much ado, let us take a look at what are debt mutual funds. Debt mutual funds, in simplicity, works like a loan. The principle is the same. Loan is something which all of us are familiar with. In a loan, there is a lender, there is a borrower. A lender gives money to the borrower uses the money for whatever purpose he needs it. The money is typically given for a fixed duration, 2 years, 3 years, 5 years. Basically an agreement between the lender and the borrower for how long the money has been given. During the currency of the loan, during the tenor or period of the loan, the borrower will keep paying interest on regular duration. And at the end of the period, the borrower will return to the lender. This is how a loan works. If for whatever reason, if the borrower is not able to repay to the lender, then that loan goes into what we call it as a default. And the lender has the right to move against the assets of the borrower. This is the principle of the loan. Debt mutual funds also work on the same principle, but with some differences. In a debt mutual fund, instead of a loan, you have something called as a bond. Bond works in principle as the same as a loan. There is a lender, there is a borrower, there is interest payment, which in bond terminology is called coupon, and there is a defined maturity date. And all the other rights also remain the same. Where a bond differs from a loan is a bond can be traded the way you buy and sell shares on a stock market. And SEBI, which is the regulator for markets, set the regulations whether it is bond trading or mutual fund. So bond can be bought and sold. Not exactly what you do with a loan, at least loans are typically not bought and sold. A bond is easily bought and sold. But otherwise, it works exactly like a loan, where there is a lender, borrower, regular interest payments, and a maturity date. Now, in a debt mutual fund, how it works is, debt mutual fund will collect money from investors like you and me, use that money to invest in the bonds issued by corporate entities such as government, banks, financial institutions, or any other corporate entity. Example of a corporate entity can be Reliance Industries, for example, or a Tata Steel. So, debt mutual fund will collect money from investors and invest it in the bonds of these corporate issuers. The rest of the things, everything works exactly the same. There is regular payment of interest. At the maturity, the money has to come back. If the money does not come back, the bond goes into a default, and the debt mutual fund can move against the assets of the borrower on behalf of you, the investor. This is how a debt mutual fund works. Now, let us look at the various risks in debt mutual fund. As I said earlier, debt mutual fund effectively invests in bonds. So, whatever debt mutual fund risk, whatever risk the debt mutual fund runs is effectively the risks in a bond investment. What are the key risks from a bond investment? In a bond investment, there are 2 key risks. 1, credit risk. 2, interest rate risk. What are these 2? Let's take a look at it. Let's first understand credit risk. As I said earlier, in a bond transaction, there is a lender and there is a borrower. The lender is called an investor and borrower is called the issuer in a bond transaction. Okay. Borrower issues the bond, investor invests in the bond. Now, Your entire premise of investment in bond works on one assumption, that you have invested in a bond. At the end of the tenor, at the end of the period, the money will come back to you. The issuer will be able to repay the money that you have lent to them. This is the whole basis on which you have lent money. Credit risk shows the risk that this issuer or the borrower is not able to repay the money to you, the lender or the investor. That is credit risk. The risk that you will not get your credit back. How do we measure it? There are external rating agencies such as CRISIL, ICRA, who will rate a bond. SEBI requires typically most of the bonds to be rated. Okay, we will stick to the broad regulations right now, not to the finer aspects. So, most of the bonds that you invest in are rated. They are rated by external rating agencies like CRISIL and ICRA, and these ratings give you an indication of the quality of the bond in terms of the probability of default. And what are the ratings? In simple terms, there is the rating scale runs from AAA down to D. D shows default. AAA and AA are typically considered as high quality bond. And when I say high quality, what I mean is the probability of default in these two rating scales are very less. AAA and AA. And as you move down the scale, the probability of default on the credit risk starts increasing. This is how credit risk works. This is the first risk. The second risk is interest rate risk. What is interest rate risk? It is a little tricky concept, so you'll have to bear with me. I will try to explain it with a simple example. Let's go back to the fundamentals of bond that we spoke about earlier. There is a lender or an issuer. There is a lender or investor. There is a borrower or issuer. The investor has invested in the bond issued by the issuer. The bond will pay interest on a regular basis. It is called coupon. At a fixed rate, it can be quarter, semi-annual, annual, as decided by the issuer or the borrower. The issuer or the borrower will regularly pay the interest. Now, on this basis, let's look at an example. Let's say you have invested in a bond issued by Reliance Industries. The bond paid was for a duration of 5 years, and the bond pays a coupon or interest of 5% per year. You have invested it. After you have invested, 3 months down the line, the interest rates in the economy undergoes a revision. If you have invested, if you're a regular investor, if you read business news, you know that just like with your bank interest rates, fixed deposit rates, the interest rates are never fixed for all the time. They go up and down depending on the conditions of the economy. So if the interest rates are revised, and what is it revised? Let us assume that 3 months after you invested, the interest rates in the economy are 6%. So if Reliance Industries were to issue a fresh bond, a new bond, they will now have to pay 6% to get money. Now in that scenario, what happens to the bond that you have invested at Reliance? Now remember, I had told earlier in the video that bonds are bought and sold like shares. So you can buy a bond and you can sell a bond. Now, as an investor holding a 5% bond, you are effectively running a loss of 1% from the interest rates that are running today. Because today, if you sell that bond and invest it in a new bond, you can get 6%. So, if you go to sell a bond which is giving you 5%, do you think you will get 6% today from the market? No. An investor who is looking at your bond, who wants to buy the bond, will look at your bond and tell you that why should I invest in, or why should I buy this bond which is paying only 5% from you when I can invest in a fresh bond from Reliance Industries at 6%. This risk of having invested at a certain interest rate and later on the interest rate goes up or down, as a result the demand for your bond goes up or down, is interest rate risk. And interest rate risk actually can get quantified into a hard profit or loss. How is that working? I'll tell you shortly. When you look at interest rate risk, there are two aspects you need to understand. One, the level at which you have invested. What is the level of interest rate today? If the level you have invested is 5%, and if the level of interest rates after you invested 3 months down the line is 6%, then this 1% is the loss that you will suffer on your bond. But if the level of interest rate goes to 4%, then your bond is better, then this 1% will be the profit you will get on the bond. I'm putting it very simple. The exact calculations is a little more intricate, but we are only here at the foundation basics, understanding the concept. So this risk of interest rate going against you or in favor of you is interest rate risk. So if you have invested in a 1-year bond, simply put, 1% is the loss or profit between 5% and 6%. But is that all it is? What happens if you have invested in a 5-year bond? In that case, this 1% difference will now need to be done for 5 years. So, if you have 1% and 5 years, you are technically looking at 5%. Like I said, the concept, the exact calculation is far more important. So, interest rate risk has two components fundamentally. How will the interest rate move in favor of you or against you? And for what duration is the bond? Because the longer the duration, the more amplified the impact of interest rate changes. So if interest rate goes up, then it is a bad scenario for you. You lose money. The longer the bond, the more money you lose. If interest rate goes down, then it is better for you. Your investment will be in profit. The longer the bond, the bigger the profit. This is how interest rate risk works. In a debt mutual fund, because debt mutual fund invest in bonds, your investment in debt mutual fund is also exposed to these two risks. The credit risk that the issuer has not repaid the money and interest rate risk. And accordingly, your NAV will go up or down. Further, in debt mutual fund, there is one more risk we need to be aware of, that is called liquidity risk. Liquidity risk, in simple terms, is when you go to sell your bond, there is no buyer for it. If you're wondering why, I'll give you an example. Let us assume you have invested in a bond. Great bond, well rated, paying you good in level of interest. 3 months later, you come to know that there is some problem with the company. The company may perhaps not be able to repay. In such a scenario, if you try to go and sell the bond in the market, what is likely to happen? One, there may not be any buyer for the bond at all, in which case you're stuck with a bad investment. Or two, the buyer in the market also is aware that there is some problem with the company and he's not going to buy the bond at the price you want to sell. He will ask you to sell the bond at a steep loss so that it compensates the risk that he is now running. This risk of not finding liquidity or buyer for your investment is called liquidity. I'll give you a real life example. Ballarpur Industries, a large company which was a regular issuer of bonds, had issued bonds to a variety of mutual funds had invested. Ballarpur Industry went into bankruptcy and problem. And at that point of time, Reliance Mutual Fund, which is now Nippon Mutual Fund, had invested in Ballarpur Industries bonds and they had to sell that bond at a steep loss. Now, in this example, you get two things coming up. One, credit risk. The credit risk of Ballarpur Industries went down and the bond investor or the mutual fund on behalf of you had to incur a loss because the credit risk went against them. Two, they also had to sell at a loss because of liquidity risk that came up as a result of credit risk. Because when Reliance Mutual Fund went to sell Ballarpur Industries bond, it was not easy for them to find a buyer. As a result, they had to sell at a loss. Similarly, DHFL Pramerica, the example that is given, also had to take losses on some of the investments that they have made. Again, typically liquidity risk is a function of credit risk. Normally, when credit risk goes bad, liquidity risk increases. It is always difficult to sell bonds which have a credit risk problem. So, friends, those are the three risks in debt mutual fund investment: credit risk, interest rate risk, and liquidity. The last question in this foundational video: what are the different types of debt? As per SEBI, the classification of different types of mutual fund, SEBI gives a classification of different types of mutual fund on the basis of where are they investing, the credit risk aspect, what kind of bonds they invest, what duration can they invest. As I've said earlier, the longer the duration, the greater the impact of interest rate movement, or a combination of both, where you invest as well as what kind of risk you have. On the basis of these parameters, SEBI has outlined a debt mutual fund into 16 categories, as it shows. Which of these categories are great to invest? Where should you be focusing is subject for another video. In the meanwhile, we will call it a day here. If you like the video, please subscribe, give us a like button. It motivates us to produce more videos. I hope you've had a lot of value in this video where you've understood the basics of debt mutual fund. If some things are not clear, feel free to put a comment in the comment box. I'll respond to you, or you can write to contact@my10cent.com with your query. We will try to answer that. There is a detailed article on this subject put on My 10 Cent. You can take your time at leisure, go through it, read it. It is very well explained. And I hope this video increases the clarity of debt mutual funds and allows you to be a better